Stage 1 going sideways, stage 2 uptrend, stage 3 losing momentum, stage 4 decline, and now back to going sideways to potentially starting to move up.
There's tightness in price action with low volume. Learn to identify that first.
During a market correction, look for stocks that have strong closing ranges, even while they're declining.
It's all about probabilities at the end of the day, which matters a lot more than picking a high and low.
Price is going tight as supply is drying up, volume is decreasing. What's that telling you? It's telling you that institutions are supporting that stock.
How is a trade decision made? This is the very first building block.
Analyze the trend, look at the price action, use 1 or 2 moving averages, keep it simple, and you'll be able to see charts in a whole new way. Building a trading foundation when it comes to reading price and volume action. Now, this may seem basic to some of you, but it's really important that we all start from the same foundation and kind of wipe the slate clean so then we can build off of that, right? I promise we're going to get into the complexities and nuances and all of that, but this foundation, it gets you 90% of the way there, honestly. Like we just said, keep it simple, price, volume, action. All right, let's see. So here we go. I said we're going to keep it simple. This is as simple as you can get, right? But you got to learn addition and multiplication before you learn calculus or differential equations and partial differential equations, whatever rye you did for electrical engineering. I don't know what you did over there, but yeah. So this is the most basic aspect, right? What is a price bar? Over here on the left, we've got an open, high, low, close bar. This is the open. This is the close. Here's the high for the day. Here is the low of the day. Some people probably prefer candlesticks. It represents the exact same information, but in the chat, just to start some drama, let me know if you're team OHLC bars or team candlesticks. I'd be interested. So let's see. We'll see in the chat here. Candlesticks, OHLC. I'm team bar myself. Rye is team candlesticks. So we've got the two parties represented here.
I switch back and forth. But
yeah.
For me, like as you go with more experience, you could switch back and forth. It doesn't really matter.
Yeah, I learned first on bars, so I think that's pretty much why I like that first. But basically, one bar can represent a year, it can represent a day, a week, a month, 65-minute period, 63-minute period, 20 seconds. It doesn't really matter. All it's taking into account is it's visualizing the movement of price action over that period, and how these 4 data points are organized, the high, the low, the open, the close, how they're organized gives you insight into the supply and demand characteristics going on behind the scenes during that candle, whether buying pressure was stronger, selling pressure was stronger. All of that is shown in the candles, and we'll talk through exactly how to interpret that. All right, and here's what I was just saying. So this is a way to visualize a bar if you kind of need. I like analogies, as you might have noticed. So this bar here, if you flip it on its side, so you turn it 90 degrees where the low is over to the left, the high is over to the right, basically the buying pressure is trying to pull it to the right, pulling this close, the current price, up towards the high, while the selling pressure is trying to pull things over to the left towards the low. And whichever is stronger is going to dominate that candle, and it will show up in where the close is relative to the high and low. If the buyers are stronger, we're going to be closing right near the high. If the sellers are stronger, we're going to close it near the low. And maybe, it changes within the candle. Maybe initially the buyers were super strong. It opens here. We push all the way here, but then the sellers really step on the gas and it closes the bar all the way down here. That's, again, information about what's going on behind the scenes. And it could be the opposite. Maybe we open up here, sellers, selling pressure overwhelmed everything. We push all the way down the low, but then buyers really took hold and we close all the way near the top. That's what a lot of people call a hammer candle, right? And these names, that we give candlestick patterns, they're not really important. What's important is kind of the psychology behind the bar and interpreting that. And that's kind of what I just went through. And a really easy way to interpret it is just visualize selling pressure as try to pull stuff down to the low, and buying pressure pulling it up to the high. And that gives you kind of a clear analogy of what's going on behind the scenes. And a really handy way to make a data point out of this that you can screen by, and we've got this in deep view as we'll go through in just a second, is the closing range. And basically what it is, you don't even have to worry about formulas if you're not math inclined. Just think about from the high to the low, where is the close within that range? The closing range is going to be closer to 100%, and you have to multiply this by 100, by the way. The closing range is going to be closer to 100% the higher we are, or the closer we are to the high of the bar. Thanks, Ryan. Glad it's 11. But on the flip side, if the close is right near the lows, this ratio is going to be close to 0%. So, you know, if this is the line in the sand, in, you know, this game of tug of war, the buying pressure is stronger if we're above 50% of the bar. The selling pressure is stronger if we're below 50% on the bar. So hopefully that makes sense. And I think this is a really powerful concept. And in deep view, we have it both on a daily and weekly basis right there for you as a data column. You can put in your data panel, all of that. And
Monthly
we've got monthly as well. And we've got a visualization of the bar right there. And I'll actually show that, you know, right now. So over here on the left-hand side, we've got the DCR, the daily closing range. This is IoT. It had a daily closing range of 96% because on this day, we're closing almost right near the highs. If this moved up and then fell back down and closed right here, it would be about a 30% closing range, right? Because we're at about 30% of this range. The weekly closing range, maybe this wasn't the best example because the weekly closing range is also very close to the high of the week because, you know, that range takes into account the high and low of that entire week. And we're also closing right near the high. But hopefully that makes sense. And let me know in the chat if you want me to explain that more. But, you know, this visualization in deep view where we create the bar for you, where it's a full candlestick pretty much. If the daily closing range is 100% or close to it, you'll see it. If it's very low, you'll see the low closing range as well. That's super handy because you don't even need to look at the chart almost. You can get a sense of what the stock is doing just with this visualization, the price percent change and the volume as well, which is another piece of the puzzle. All right. So weekly closing range during corrections. This is something that I picked up from Mike Webster. He did a webinar, I think it was with the Arusha and maybe Joe Fahmy a while ago. But something that he picked up from William O'Neill is during a market correction, look for stocks that have strong closing ranges, even while they're declining. So this is during the 2020 correction. You can see each of these bars represents 1 week's worth of price action. And you can see that 3 out of these 4 down weeks close basically high up in the range. They're closing far off the lows. This one, you know, it is kind of neutral. But the 1, 2, 3, these 3 bars, look at them. They're basically forming crosses here. They're closing pretty close to highs, even though the market is declining 30% in the most rapid, you know, correction of I think it was ever, maybe outside the crashes. But this stock was fighting against that. It was being accumulated, pushed up by institutions. And after, you know, the market pressure lifted, we had a beautiful trend. I think this went on and doubled. And there's so many examples from this time of stocks that were fighting the trend, good closing ranges, even when the market was going down rapidly. And you can also see this in the relative strength line. You can see, you know, this trend is increasing even as the stock is declining. And these pink circles here identify when the relative strength is making a new high. And you can see it's happening before price. Price does not make a new high until way over here. But you had many early signals of strength by looking at the relative strength line. It's increasing over this period. It makes a new high on this bar well before we actually break out of the base. So that's another thing that you should be on the lookout for. And we'll probably dive deeper into the relative strength line later on in a future webinar. But what's important is to look at the weekly closing range during a correction. Ryan, did you want to?
No, you can keep going. I'm just answering a few questions there.
Yeah, you're moving the mouse. So good. So next up, identifying trends. Again, we're keeping this simple, but I promise we're going to build off this. Very simply, what you can do is add a moving average to the chart. And we get asked so many times, what's the perfect moving average? What time period should I use? It doesn't really matter. It should fit your kind of time frame. If you're an intermediate term trader, maybe the 50-day is good for you, 200-day is good for you. If you're more of a faster swing trader, maybe the 5-day simple moving average is good for you, the 10-day simple, the 21 EMA. Align them with your time frames, and they should have a purpose, right? They should either help you identify the trend, or you should have rules dependent on them, right? You shouldn't have a moving average on your chart just so you have 5 moving averages on the chart. That's just noise at that point. Make sure it has a purpose. Here we're on a weekly chart of, again, NVIDIA. This time we're looking at the 2022 correction as well as the uptrend that resulted from it. We've got a 10-week moving average in red here. Also, when it comes to choosing moving averages, a lot of people focus on certain ones, which makes them a level of interest, to quote Brian Shannon. So it's often good, the 10-week is a known spot of institutional support, 50 days the same, 200 days the same. So, use your discretion, find what works for you, and also look at what the stock itself respects in the past. But getting back to this, just looking at the trend of the moving average and price action relative to that, you can identify and sidestep a lot of the major corrections. Here we're above a rising moving average. That's good. Here we're below declining moving average. We pop up a little bit, but we get back down below declining moving average. This is the definition of a downtrend. We're trending below a moving average, the average price over a period. And that doesn't change until pretty much here, where consistently we're above a rising moving average, and now it's held that for many months in a row now. So just adding 1 or 2, keep it simple again, moving averages can really help you define that trend. And we're always looking for uptrends above a rising moving average, and that can last, that trend above the moving average can last a lot longer than you think. But also on the flip side, trend below declining moving average, that can also last a lot longer than you think. And then one more way to define a trend is just looking at relative peaks and relative lows, and looking at what the trend is here. Here we're in an uptrend, we're making higher highs. Then we make a lower high. It's an intermediate, it's still a higher low here, but then we make a lower low. We make another lower high. We make another lower low, lower high, lower high, lower low. So if we're making lower highs and lower lows, that's another way to define a downtrend. And then at this point, we make a higher low compared to this low. We make a higher high compared to this high, and the trend changes, and off we go to the races. So for downtrends, lower highs and lower lows. For uptrends, higher highs and higher lows. And that's kind of the definition, another way to define a change in trend. And Ryan, jump in if you want to add anything to what I'm saying here.
Yeah, no, I think you discussed, the slope of the moving average kind of tells you all you really need to know, right? For a trend to confirm, a very simple way of looking at it is the slope of, let's say, the 10-week line, what that means. So if the slope is down, it means that the stock on a 10-week closing basis has trended lower. If the slope of the 10-week line is up, it means that over the last 10 weeks, the average weekly closes are now trending higher, right? So as that happens, pointing up or pointing down, the best spot or where decisions are made in the market is when the slope of multiple moving averages, which we'll get into,
The
is
launch pad.
what that tells you is now there's indecision. Whatever the primary trend was, be it the uptrend or the downtrend, the existing slope of multiple moving averages being flat will tell you that it's now time to make a decision on whatever the primary trend was, if that's going to continue, or that primary trend is going to switch to the opposite of what, could be a downtrend, an uptrend switching from a downtrend, which is stage, from 2 to 3 to 4, or you go from stage 1 to 2, which is the primary trend was a downtrend, and now you're switching to an uptrend.
Yeah, and I saw somebody mention this. This is kind of an inverse head and shoulder, where you've got a shoulder, and the head. Again, we're trying to talk about the pieces and the psychology behind price patterns. It's all good and well if you love calling it inverse head and shoulders and all of that, that's a helpful frame for you. But when you're first starting out, you don't just want to take a sheet of patterns and memorize and just look for that. You want to understand why the trend is changing. The inverse head and shoulder is basically you go from lower highs, or sorry, lower lows and lower highs, to then you start putting in a higher low, and you put in that first higher high. So you don't need to memorize what's an inverse head and shoulder, what's all these different names. There's so many out there. Just analyze the trend, look at the price action, use 1 or 2 moving averages, keep it simple, and you'll be able to see charts in a whole new way. So that's just what I emphasize there. Yeah.
Yeah, and one thing that you could do, again, we're talking stages, right? So if you're stage 1 or you're stage 2, go back and pick a random stock, go back in time and do this. Mike Webster is big on this, is do a bar by bar, right? So just a hypothetical kind of a simulation for yourself in the back of your mind to train yourself based on, you could do this on price only, right? You could say, okay, right now we're at what, 400 something, Nvidia put in a down bar right at 440. What is your expectation at that point, right? And then you click and you see the next bar. And based on that, you could kind of train your eye. You could do that only for uptrends. Some people tend to do that just to learn that quality uptrends do this. Or you could do just any random, stock and see based on, at that current moment, and you press that arrow to the right and it loads to the next bar, your interpretation level of how price action is forming, couple that with volume to make better decisions, right? Will improve over time. And you could do this maybe, set yourself like a Saturday morning reminder. Say for 30 minutes, I'm just going to pick some, maybe a prior successful winner or some other trend, and just try to go bar by bar, trying to see how you would trade that. The best way, obviously, Richard, maybe someday in Deep You will do it, is we could, mask what stock it is. You pick kind of like a random stock, it loads it for you, and you go bar by bar. You have no idea what this stock is doing, but you could have maybe your relative strength line, price, and volume bars, and you just see if you're going to, you could interpret the very basic price action and identifying trends, be it uptrend or downtrends, week to week, day to day, even 65-minute bar to 65-minute bar. So
yeah, I think it'd be cool to have a set of model book stocks that people can load randomly generated, and then they can trade it as if in real time. And in DeepView right now, you can use the arrow keys to go bar by bar. But yeah, we'll be introducing a lot more features along that frame of mind. So let's see. Let's keep on moving here. Stage analysis. This just adds, overall framework, and we did an entire webinar last weekend about this, and we'll be posting a link to that shortly and all of that. But basically, we're looking for four distinct stages. Stage 1, sideways movement. Stage 2, like I said, we're forming higher highs and higher lows above a rising moving average. Stage 3, we lose momentum, undercut, that moving average a few times. We're no longer forming higher highs. We might still be forming higher lows. Then stage 4, we start forming lower lows and lower highs and declining below a moving average. So it's one more way to label and identify what price action is doing. And this appears on a weekly time frame, which is what Stan primarily used, a daily, an intraday. This same cycle is driven by supply and demand, fear and greed, and occurs on every single time frame. So learn this, master it, be able to determine uptrends and downtrends, and that will solve 80% of your problems, right? Just being able to identify that and know what you should do in those uptrends and downtrends, right? You don't want to be trying to buy breakouts when we're in a downtrend. You don't want to be trying to go short in stage 2. All right.
Yeah, if we just go back for a second. So let's just take a look at the concept. I think the important part is to understand the psychology of it as well. So the slope of a moving average is just telling you that the average closes over a span of time are, positive, negative, or flat, right? So stage 1 is when price action, the 30-week moving average is coming into price. and now the stock is done going down, right? Or potentially be, is done going down or it wants to kind of, on a 30-week basis has built out a base, and now there's potential that it could charge to the upside. When the moving average is sloping up higher, we're seeing those, what Richard said, higher lows and higher highs, right? And that's causing the slope of the moving average to be to the upside. The same thing happens in stage 3. The momentum is kind of sucked out of the stock. We now have a flat moving average. That means the stock is, the momentum it had in stage 2 has kind of gone away, and there might be stage 3 can turn back into a stage 2, right? There are many, many examples of that. But you have to wait for the slope of whatever it is. It could be the 10-week line, maybe a 2-week line, whatever time frame that you're trading. You have to wait for those slopes to point up or down for you to dictate trend and read the price action accordingly. So,
Yep.
Richard, we can go to the next one.
Yep. I've got control yet. Oh, I got it. Let me control it. Here we go. So this is a real life chart. This is ROKU looking at 2020 into pretty much where we're at this year. You can see a stage 2 uptrend up here where we're forming higher highs and higher lows above the longer term moving average, which is the 40-week moving average. Then we go into stage 3 or even stage 1 here, a little bit of stage 4 in the correction, but then everything compresses. And this is what Riot was alluding to with all the moving averages tightening together. This is the launchpad setup, which we'll cover I think it's next webinar when we go over setups. Here we get a breakout on volume. We start again to trend above a rising moving average. Look how it respects the 10-week line. This is a textbook example. And this is another stage 2 uptrend. Then we get into stage 3 where we break below the 10-week. We start getting wider and looser. We try to break out. We can't. We fall below the 10-week. Can't form, really any base. Can't form any momentum like we saw back here. And then we break below these lows, below all the declining moving averages, lower highs, lower lows, and begin a really disastrous downtrend. From this failed breakout, that was close to $500. This fell to the 40s. So stage 4s, you really want to learn to identify them, even if you're a longer term investor, because they can be disastrous when the market factors change and the conditions change and we enter a bear market. The prior leaders that can double, triple, and quadruple can easily give that back and more. We saw that with so many examples. C Limited is another textbook stage analysis chart where we go up and all the way down. So here we're forming again kind of stage 1. We're starting to trend above the 10-week now, so potential stage 2. But here's a stage 1 going sideways, stage 2 uptrend, stage 3 losing momentum, stage 4 decline, and now back to going sideways to potentially starting to move up with a new stage 2. Brian, anything to add here?
Yeah, and what we're doing here is, just to be very clear, we're just building a 30,000 feet type of view of how price action tends to happen in the markets with the stage analysis framework, right? This is not talking about where you can enter, where you can exit, where you can short, where you could go long, right? The idea, so a lot of traders get enamored with the fact that, how do I short this right at 445? Show me a system. Just to let you know, Stan Weinstein would short this at 265, FYI, he's waiting for this consolidation of that stage 3, the slope of that 30 or 40-week moving average, and he would draw a horizontal line here, and that break on increasing volume right around here on these two, I might not be pointing at the right volume, but he's looking at the low of that consolidation to break down for him to enter. So the fact that traders get enamored with the fact, how do I completely, to the penny, maybe to the dollar, figure this out so that I could be in this awesome downtrend from 445 to 3750. That's not going to happen. And that's just the reality of things. The opposite is also true. How do I enter right at, $50 and take this to 445? And magically someone tells me that this is going to a stage 3. What you want is, you want to catch a chunk of this trade when it's in stage two, and your position sizing and your conviction and how you've studied trends will dictate. A trader can put on a 3 to 5% position at 50 and sell it that 3 to 5% position at 445, and he won't make a dime. Whereas I can study these uptrends and wait for my probabilities to line up and put on a 15 to 18% position and make twice, maybe 5x the money that another trader could make. So it all comes down to having some perspective. Yes, it would be magical, and you'll feel good. You could do that at Disney World. That doesn't work here. Just FYI, you can't catch. You will not catch this at 50, and you will not sell this at 445. You need to move away from that perfectionist mentality when it comes to the stock market, and when it comes to these daily, weekly, whichever time frame type of charts. Traders are very enamored by the fact that someone can pick a low, but it's all about probabilities at the end of the day, which matters a lot more than picking a high and low on a stock. So
Yeah,
Richard, you can keep going.
Yeah, Jesse Livermore says the most expensive ace in the world are, the first eighth and the last eighth. You just catch the sixth ace right here, and you'll make a fortune if you can do that consistently, and if you can avoid this right here, right? All right, next slide. Here, yeah, don't move the mouse if you can, right?
No.
Here we're talking about bases. So this is ELF looking back 2022. I mean, this has had a model book move. It's still going. We'll see when this stops. Who knows? But this was its first big base in 2022. Breaks out of that, forms a base here, base here, base here, base here. And a base is simply a short-term sideways move for at least a few weeks when we're already in a longer-term uptrend above the rising moving averages, right? That, keep it very simple. It's just a consolidation, a pause that then resumes upwards. So you don't have to overthink it at all. Bases can be a lot bigger than that, and that's basically your stage one here. It creates the foundation for the move. Just like we're creating the foundation for trading here, the big stage ones create the foundation for a potential move like this. These smaller pauses, they are potential entry points as it resumes upwards in the already existing trend. So that's all you have to remember here.
One thing, if you go back, I just want to get very granular. So let's say that this stock right here, oh sorry, Richard, this stock right over here was, we see flattening 10-week and 40-week lines. This could have broken out here and done a stage two, right? It's not to say, oh, it has to do this, right? So if these moving averages are flattening and kind of converging or building what we call a launch pad, this could have easily maybe a pivot of 30, whatever it was. If the market was fine, this trend that we see, we can kind of move it all the way here, and this could have done that, right? Entirely possible. But the fact that we ran into that 2022 market, this went into a bigger base, is absolutely fine. We see declining moving averages right here, lower lows and lower highs. And then when we see this 10-week and 40-week flattening up right here, right? This red line, the slope is flat. It means that it's the downward momentum is now kind of sucked out of that stock. And that black, the 10-week line, which I'm assuming is the red, and the black is the 40-week. When they go flat, it means that the downward momentum is kind of gone away. And now the stock, it may be, just maybe, ready for an uptrend as well. So using the slopes and looking at 10-week closes and 40-week closes can give you a really good way of identifying if the momentum to the downside has been sucked out or the momentum to the upside has been sucked out, and the primary trend of the stock can potentially switch to the upside or the downside. And yeah, I mean, we had this 2022. I think things got really good later in that. For this stock, I mean, me personally, I still beat myself over as to how I have not traded any of this whatsoever. But really good example. And then also we talked about the rising 10-week line acting as support or tends to be what people call institutional support in the markets. The reason that they say that is because they've gone back and studied a whole bunch of stocks, and they see that the 10-week line continuously on a closing basis tends to support model book stocks or stocks that have doubled, tripled in the past. And that's why we're using that as a reference or a guide going forward or future looking, where we say, okay, the stock has broken out, it came back into its 10-week line, was supported. That analysis that we're doing is based on the fact that we've gone back and said, what did stocks back in 1990, 1995, whatever, 10, 20 years ago, 15 years ago, where were they supported when they made these big runs? The answer seems to be this 10-week line on really, super trends to the upside. So we could use that as a guide going forward.
Yeah, and a few things here. I saw a few questions about the moving averages I'm using for stage analysis. I've hidden the 30-week moving average just to keep it to 2 moving averages to keep it cleaner. It's easier to present that way. Stan on a weekly uses the 10-week, the 30-week, and the 40-week, and on a daily chart uses the 50-day, 150-day, and 200-day, all simple moving averages. So we're just keeping it cleaner with 2 moving averages. The 30-week and the 40-week are going to give pretty much the same information. They're both a similar time frame. Also, I saw some.
Let's address.
Yeah, I saw a question about this bar here, and again, we're going to go in depth into position management and like rules and all that stuff. But just look using what we talked about today. What's the closing range on this bar? Drop in the chat. What's the closing range on this bar right here? This weekly bar on high volume. So I'm going to wait for some answers here.
Very close to 50.
Yeah, close to 40, 50. So what does that tell you about the stock? Let me know here. So it's very high volume. It's a red bar. But what does the closing range tell you? Yeah, good close. Yeah, some level of support. So
now, mind you, like let's say you have a position here and you completely sold it based on this. That's perfectly fine. The idea again is if this remains, it reclaims the 10-week and continues on. You could always have mechanisms to buy it back. The idea is not to, even if you thought, that bar is 48% and your rule says that it has to be 50% or more, fine, you sell it. You made some progress. You had a higher, you made something from that stock based on your rules, perfectly fine. And you could always re-enter. There's the idea of, 32 I will buy, 140 I will sell, and it should never move above 140 because I want to feel good about myself will never happen, right? So
it's the idea. Yeah, it's the idea. It's the sentiment behind it. And even if you have some idea about what's going on in this bar after, on that during that week, it's about what happens after it that confirms it, right? It reemphasizes it. And midweek, this was right down here. I mean, that's scary. I mean, like Rai said, if you bought it early on here or this breakout, and you sold out because your rules told you, intra-week, if we break the 50-day, I'm out. That's perfectly fine. That's a stellar trade from the 30s to the 50s. That's a great chunk. But yeah, keep an eye on stocks that even if you sold out, if they set back up, we've got a really tight inside week on very low volume, and then it resumes upward and then breaks out of this base. So keep an eye on those stocks, even if there is an ugly shake-up bar like there that then closes pretty strong. That to me indicates demand. Even though this is scary, huge red volume, it's kind of subtle accumulation at the same time.
And also, and one more thing. Yes, we will never know where this would close, but our convictions and what we see are based on, doing our Saturday morning bar by bar, studying prior uptrends. Ross, who was a portfolio manager, William O'Neill, was part of a team that turned, I don't know the exact numbers, like 15 million to 850 million. He's drilled down, when you have a proper position, he will wait till the end of the day to see what the closing range is. He would wait till the end of the week. If he has a proper position from here, right, he will wait till the end of the week to make a decision, even if it meant that this thing just kept going down throughout the week, maybe even came back a lot more. But those are things where you have to have some level of perspective based on what you've seen in the past, so that you can catch some of these super runs, right? These weeks don't feel good. These even that this week doesn't feel good. It allow, you question yourself,
It
but
looks
that's where
great
your
after the
buy and
fact.
sell rules.
Yeah.
Yeah, that's where your buy and sell rules kind of come into play. Because if you operate based on this is emotional, this thing is emotional. You're giving back 14, 15 points in a week, and you were feeling pretty good the prior week, right? Now, if you operate based on what rules you have, look at it from 50 trades I'm going to make, 100 trades I'm going to make, 300 trades I'm going to make in my career, over a span of 5 years, for example, or 6 years. Is that going to allow me to catch this, or is it not going to allow me to catch this? It's about a series of trades, not that, if I need to be perfect right here, or I need to make sure that, all I'm trying to say is your decision making, again, we'll cover this. You have to have buy rules, you have to have sell rules based on what you've studied in the past or your experience and knowledge that you've gathered along the way. And in these moments, you have to stick to those. You can't be emotional. Like, we can try to reduce our emotions by having very set buy and sell rules as we possibly can.
Yeah, and we got to manage risk in real time. I think that's key. But Ross has different objectives, different style than I do, than Rye does. I'm much more of, trying to trade this breakout to the start of this base, this breakout to the start of this base versus I know kind of what I can handle, and I can't handle a deep base decline like this. These are pretty shallow, but I'm much better operating base to base than holding through multiple bases. I'll try to get back in when it restarts that momentum. So know yourself and know what you can handle. All right. So here's a daily example of two bases here. This is a daily chart of Uber. This is earlier this year. Look at the power off the bottom here on huge volume. Then it consolidates even more. You could almost call this, it's not a perfect base, but it's a consolidation. We don't really go higher or lower for a few weeks here. Pulls back into the 21 exponential moving average, trends above that. So I like operating, as we're trending above a rising 21. That's kind of my sweet spot. And then we undercut that 21 EMA and start to form a new base, and we'll see where this goes from here. But to form a base on the daily chart, it has to stay below a key level for at least 10 days, 15 days. You can define it for yourself, but a decent chunk where it's consolidating below a level. We form one here starting at about, maybe this period is where you can draw on this pivot line. At this point, we rally up, we go down here, break the 21. At this point, this becomes a key level down here, all that stuff. So again, you can use the same methodology with the moving averages. It doesn't matter what time frame you're on. Here we're trending above a rising 21 and 50 day. The longer term moving average is an uptrend as well. So all the concepts we're teaching apply to many different time frames. So Ryan, anything you want to emphasize on this chart or when looking at bases on a daily?
No, again, we're just purely talking price action. You obviously, want to add, we will add volume to the equation very soon, right? But this is, we want to really focus on, if, let's say volume didn't exist, how would you be trading, right? If you could master that perspective, and then volume will only make your decision making better, right? Week to week and month to month. So
Yeah. I mean, volume, very simply, it adds emphasis to the price bar. So here we're getting gap ups, good closes on large blue volume. Here, the day after we put in that high, we get a red bar that is wide range, closes near the lows on the highest volume in, a few weeks, a few months here. So that's telling you that the selling on that bar is more serious. So volume just adds conviction to what price is doing. All right. Next up, tight areas. So here's kind of my textbook chart for tight areas. Tesla in 2020, we've got the base that forms, the resulting move up, breaks out, and this starts a monster move from these lows. In your mind here, as you look at the chart, we're going to show the tight areas on the next slide, but in your mind, go through the price action here and identify to yourself, where is it tightening? Where does price action go sideways and tight on low volume for, at least 2, 3 days. That's kind of how I visualize it. Where does it get really tight? And what does a tight area signify? It basically signifies that there's subtle accumulation, sellers are getting worn out, and institutions are propping up the price and accumulating as many shares as they can. And often tight areas resolve in the direction of the prior trend. So they can be a pause in the downtrend where for a little bit, buyers are fighting the trend and holding it up, but then the sellers take control. The same thing in an uptrend. We move up, then we go sideways, and then we get tight. Sellers are getting absorbed, and then we resolve to upwards for the most part. Obviously, the trend can always change. But let me know, think to yourself, looking at this chart, where does it get really tight on this chart? And this is a key thing to be able to identify on charts. All right.
And repetition's key here, right?
Yeah.
That's why I say, set yourself a Saturday morning reminder and just maybe, once a week. Some people should do it more than once a week, depending on the stage you're in. If you do this, you're building in the back of your mind, let's say, basketball players when they practice versus when they play a game, those are two very different things. In the game, it's more instinct. When they throw a pass, it's just more natural because they've kind of practiced that, right? And real time analysis when you're being guarded versus practicing something, a lot of back of mind, just the way we work as humans, like things when they're based on, I've seen this before, and I feel, you will develop a gut feel for those situations. As of today, all I trade based on, when I'm placing a trade, I kind of, in the back of my mind know that this feels pretty good, right? Versus another trade I might have placed or forced a little bit. And you kind of develop that through repetition. Like look at as many stocks as you possibly can. And I'm getting very excited about, we need some sort of simulator to do this.
Yep.
Where you can't see it's Tesla, you can't know anything. All you know is price volume, maybe whatever indicator you want to put a MACD, you put a MACD. But that repetition will help you so much because real-time analysis is based on what you've trained yourself to look at when the market's offline and the market's not, trading at all. Those things just get better and better with repetition. So.
Yep. So I didn't see enough responses, but I'll give you guys. I'll let you guys pass today, but here's the answer. This is kind of my work about where it gets tight. First, in the downtrend, we get tight relative to prior action around here for a few days. We resolve to the downside. We form again. Look at this first higher low that forms, the first higher high that forms. We get tight for maybe 2 days in here, resolves to the upside, pull back a little, get tight again for 3 days, move up. This was earnings, I believe. Yep, earnings right there. We absorb that selling, move up, again, gets super tight. And then just throughout this area, it's tight, moves up a bit, tight, moves up a bit. The tightness is it's just such a tell that a stock is under accumulation. So tightness here, gets super tight for 2 whole weeks, breaks out of, if you want to call this a cup and handle, you can just keep it simple and say it broke out of range here. Again, it moves up, gets tight again for 4 days, moves up, a little bit of selling, holds the moving average, moves up, it gets super tight. This is probably the tightest it is on this entire chart. We do a little shakeout, but where do we hold? The moving average, as well as if you draw a line from this high over here, we also hold that same level. That's another reason why this level is key. You always want to be aligning different areas of confluence, different areas where different strategies might look to enter a stock and build positions. So after this, and even this is tight. It's just not quite as tight as this, right? I mean, this goes pretty much sideways for 4 bars. Again, it's not as tight as this, but it is tight. And then this really starts the move. We get a 20, 30% move in just a few days. We tighten up again and move higher, form another base, get really tight within this base, have a little bit of a shakeout, and then we have a kicker candle, expectation breaker. It starts another move, and look at the volume pickup on this breakout, and look at the volume pickup as we broke out of this tight area. So during the tight areas, you want to see a decline in volume overall. That's telling you supply is drying up. And then when we resolve to the upside or downside, depending on what it is, we want to see a pickup in volume, and that's key. So
And
Yeah,
there's a very good point by one of the folks in the chat. It's so obvious in hindsight, right? It's so obvious that this stock is continuously moving up and it seems to be very easy. But what we're trying to, what you should, I guess, focus on and understand is, can you identify this as it's happening,
yeah,
right? Then you can, if it moves out of that range, you can make a decision. Can you identify this as it's happening? Then it moves out of range, then you could get in on this. So the first portion of, the first part of it is trade identification. What allows, a setup to be something that's good enough for you to track? What are those characteristics? What do they look like, right? And then the second portion is, you've identified, okay, I want to have Tesla back in May of 2021 on my watch list. That's your first step, the very minimum requirement, the very basic requirement that you should put for yourself. Now, how will I enter? Based on, if this tightness resolves to the downside, I will do what? If this tightness resolves to the upside, what am I doing? Your actions are then based on your trade identification. So there's a step-by-step, method where you have to build. And as you review more and more charts, you have to build that identification. It has to be, in real time. You're supposed to be doing this, and we don't know what's going to happen in the future, right? Hindsight is always 2020. Yes, this is in an uptrend, super easy. Just look for tight stocks, and if they break the range, you go to the upside. That's a very simplistic way of looking at it. The other way is, based on what I've seen in the past, this stock is getting tight, the volume is relatively low, and if it resolves to the upside, this is a potential position I will put on. This is the X, if it lines up with another pivot, that makes it another, even more important area on the chart. I've seen this before, and when I traded something like that a while ago, or when I studied that X breakout a while ago, this seemed to be a very important point on that chart, and that stock did this. There's a probability that this stock will also do this. So you have to be able to identify these in real time. That's your first trade identification. If you don't master just the very basics of, I will have Tesla on my watch list just to watch to see what happens, it's kind of like a whack-a-mole feeling. Then you don't know which one, what stock, what to look for. You have really no clue as to how you'll go about it in the markets. And then, when you look at these, all you're kind of seeing is, oh, this is easy, it's hindsight. I could just look at type. So real time trade identification, then building which we'll get into over the next 7 weeks. How do you plan those out? And then how do you position size based on that? What is your framework for market cycle telling you? And when those probabilities align, this thing, breaks the upside, you're acting, and you're acting real time, because you've identified it, you've done your homework, you've connected your current state to some past state, you've studied and done your homework, and the market is going to reward you when you look at it in real time. So I
yeah.
think there's bits and pieces to this puzzle. And this first piece that we're going over right now, which is reading price action, it's the first identification puzzle, and then we'll add bits and pieces to it so that you could increase your probabilities going forward.
Yeah, we're going over the winning characteristics, the building blocks that allow you to identify constructive price and volume action. And in hindsight, yeah, it's easier to point out the tight areas, but in real time, this was one of my biggest winners in 2020. It was one of Ross's, I think it was Ross's biggest winner in 2020. Oliver Kell was all over this. And why was that? Is because they've studied the template of winning stocks in history and identified the price and volume as well as fundamental characteristics that lead to the potential for something like this. So at this point in time, they notice it's tight, it's a constructed pattern, it's in a leading group, it's got triple-digit earnings growth, and that's why they're focused on an entry in that. So I think we can leave it there. But again, just being able to identify the tight patterns and noticing that characteristic takes you a long way, right?
Yeah,
So
I think that's
yeah,
something, if Nick, I know Nick's here and watching. So I think like breaking down how is a trade decision made? This is the very first building block. It's identifying, it's the identification and placing something on your watch list. The second, obviously, what is your entry tactic going to be? What is your risk going to be? What position size will you place it at? And as you sum those factors up, then you increase your probabilities of moving from a stage 2 to stage 3. But this is the very first building block that we're focused on.
Yeah, and I'm not sure if we got this question before I explain it, but it's worth going over again. Why is tightness a sign of accumulation? It's a sign of accumulation because price is going tight as supply is drying up, volume is decreasing. What's that telling you? It's telling you that institutions are supporting that stock, keep subtly accumulating as the sellers that are there wear out their positions and ultimately sell out everything. And what does that create? That creates a supply and demand dynamic where there's very little supply coming to the market, and we've got the institutions with some demand supporting it. And then finally something will shift where another buyer comes in, or the institutions decide to ramp up their accumulation, and it just tips the scales, and suddenly that creates the uptrend. So basically the tight area is a balance in supply and demand where one of those is getting worn out, and then we're waiting for where the scale is going to shift next. I think that's an okay way to explain it. So reading price action pivots, again, this is a very simplistic view, but we're going to build and build and build. So how do I define a pivot? A pivot point is a specific level / area in a chart pattern where we can expect the stock to become directional. Ryan, I think I stole that from you, pretty sure. But basically, it's a spot that's in the eye of the markets where, again, the supply and demand scale is about to shift. This is where the energy can get released, both to the upside or downside, depending on the setup. For me personally, it's often the high of a tight range. So if we go back to Tesla, through these highs is a pivot, through these highs is a pivot, through these highs is a pivot. But it depends on the setup, right? You can define it many different ways. A base pivot and a consolidation pivot are slightly different, but they're looking at the same thing. There's a move up, a consolidation, and then a continuation, right? And it's the same to the downside. A move down, move up slightly, and continuation. And that low there is the pivot in that case. So again, pivot point, I think, is that the exact same slide? Yeah, that's the exact same slide. It's just really important. That's why we want to emphasize it again. So here's real time. Again, this is Tesla. These are the highs of the range. This is the pivot point, this line of resistance. This line of resistance is the range. And this could be a 5-minute chart. This is a daily chart here, but it could be a weekly chart, right? A base pivot is basically looking for a longer consolidation on a weekly. Here we're looking for shorter term actionable pivots on a daily chart. It just depends on your time frame. But when it comes to pivots, right, anything that you want to really emphasize?
Yeah, let's actually do
let's go through it.
Let's actually do like a bar by bar type of thing, just to get, just to emphasize the point of, what we're trying to get you guys to do as what we feel, is very important to do as well. So if we pick up this stock at this bar and we see another level of tightness, I would draw my pivot here at the top side, and I would say if this stock moves above $69.50, I will be potentially interested for this to break out of that to the upside if the volume is there, right? So then I start tracking it. Okay, the stock moves down. I have nothing to do. I will continue tracking to see how this is functioning. The primary trend is to the upside. So I don't really see a huge reason, just based on this chart alone. We don't know some of the other factors that could, go into this. So there's nothing to do for me yet. The stock closed back again. It's above the rising moving average. The volume is picking up. Well, that's a subtle sign, my expectation after this third bar over here is that this stock will now break the moving average because the volume is picking up as it moves down. Well, what does this stock do? It doesn't break down. breaks my expectation and moves up. And
Hmm.
now as of this bar, I'm kind of neutral. I don't know what's going to happen. I still don't know what's going to happen at this bar, but I will continue watching it through the top side pivot. And if and when it does that, I may be interested, depending on just if we take isolation of this price action and volume, I may be interested as to what's going on. So on this next bar, my expectation is it could potentially just go out of there. But what I would like is some sort of consolidation to happen personally. And that's what we kind of get. This consolidation is tightening formation. So this bar, we get some tight close. Another bar, we get a tight close. And what I'm starting to notice is the volume is starting to dry up as price action is tightening. This bar, now I'm ready. I would be kind of, this red bar that we see, I'm ready because we're seeing tightness in price action with lower volume happening. And I will be anticipating because I can, and I've seen this before somewhere, right? And I'm connecting some previous day. I'm ready for this thing to maybe break out this next day to the upside. If it does, I will act. If it doesn't, which it didn't, it put in even lower volume on this day and continued to trade tight. What did we say? Tightness in price action on decreasing volume tends, could potentially result in a bigger breakout. So continue watching, continue watching. Hey, this pulls back into a rising moving average. It pulls back in on, increasing volume. What's my expectation the next day? What's my expectation? You could set yourself an expectation. It's absolutely free to do in the markets. Nobody's going to question you, right? My expectation is this will continue to the downside. That's my expectation on the very next bar. Hey, it doesn't do that. It again breaks my expectation, continues to trade within this type of range. I'm expecting this next blue bar that went up to be down because we saw increasing volume to the downside. My expectation is some sort of follow through to the downside the next day. That didn't happen. This continues to kind of tighten up. And what we see is eventually that pivot that I started tracking on this very day. Again, the primary trend is to the upside. The longer term moving averages are also pointing to the upside. So my bias from here all the way to here, unless the stock completely breaks that moving average to the downside, will be, I will have a bullish bias on this top side pivot. And eventually what it does is it breaks this range on increasing volume and volume that is comparable, that is higher than a lot of this consolidation that happened. And when that happens, something's going to click in my mind. I've tracked this long enough. Likely the market is pretty good that day as well. I can manage my, there's increasing volume coming in. We'll get into the very granularities of how you can enter, what position size, etc. later. But this is now breaking to that upside. I tracked this for a couple of weeks. It's running, it goes, maybe I get, my entry at the top of that bar. Maybe I get my entry really, at the beginning of the day. Those granularities we'll get into, but the general idea is you track this, it triggered to the upside, and we get a rally out of it. Be it you enter at the top of that consolidation, somewhere closer earlier in that consolidation. That depends on your entry tactics, but that's the identification part of it, right? A name that's primarily in an uptrend is tightening on low volume. When I'm expecting it to break down, it moves up. When I'm expecting it to break down here, it moves up. It's continuously breaking my expectations of what I think is going to happen, and it eventually breaks out to the upside. So if you do that exercise, right? Historically, it will help you real time. It will help you week to week kind of gauge that price action that's happening. And that's, it will allow you to build in the back of your mind this instinct, like you'll build this and it will become more natural and you won't even notice, but when you feel good about something and it's happening, you'll position size a little bit more because you've seen this before. So that's what we kind of want to emphasize. Now, how do we narrow down to a Tesla? What factors, how do we build a watch list where the probabilities of winners being on that watch list, we will get to that. What I'm trying to get you guys to focus on right now is if there's some expectation breakers happening, there's tightness in price action with low volume. Learn to identify that first. If you can't learn to identify that first, and you just want a recipe for this to be on your watch list magically, you're not going to go from stage 1 to 2 or 2 to 3. Just skipping from stage 1 to 3. That's never going to happen. So, Richard, you could take it back.
Yeah, no, that was fantastic. And yeah, I want to emphasize a few key things. First, obviously, we're looking at the chart in hindsight,
Yeah.
but I bought it on this day and I added on this day because of exactly what Rye was talking about. And the concept of an expectation breaker is so, so key. And that's an amazing nuance here. Here, when it's forming a tight bar, ignore everything, to the right here. We're just talking about this tightness. This gets so tight. I was waiting for it to break the topside pivot and this pivot here because they're lying close together. That adds power. Again, the more people who are looking at a similar level to buy, the more power that's going to have. Then on this day, I was super disappointed because it broke my expectation. It broke the low of this range. However, it's not done yet. I mean, it's still above a rising 21 EMA. It's still above this low here. There's nothing really wrong with the chart. Just on this day in particular, for whatever reason, it wasn't ready yet. And then these bars where, again, another expectation breaker, this time a positive. This was a negative expectation breaker. From this type of setup in a bullish pattern, we expect it to explode out and go. We break to the downside instead, but there's no follow through. In fact, we try to go lower and look at where they close this bar. I mean, we talked about what's going on, supply and demand, buying pressure, selling pressure. Who won the tug of war on this bar, right? The buyers. Then the next day, again, lower volume, so there's less emphasis to what that day is doing. Price action is still key, but just keep that in the back of your mind. I mean, it pretty much goes sideways. We end near the lows, but lower volume, hold the rising 21 EMA still. And then the next day, this is why I bought it. Again, we tried to push lower, and then we broke out through this high. The sellers could not push this any lower. Volume a little bit higher than the next day. And then the next day, we get the real breakout through this pivot as well as this pivot. Again, this is kind of more intense than I wanted to go today. This is a little bit more advanced, but because these pivots are so close together, it adds fuel to the fire. And this lines up with, if we go to the slide before, this lines up with the top of the base. So there's a pivot from a higher time frame that I think is like right around here or even closer to here. So everything is lining up. All the pivots are lining up. The expectation breakers are telling you that net, it's still under accumulation. And it just takes off and goes and continues on and has continuation days up, which is the best sign a breakout's going to hold. And I don't want to go bar by bar just because it would take a lot more time of this consolidation. But this is homework for all of you guys. Go through this section and go just as Rye did through it. And what does each bar tell you? And you've got a lot of days where they try to push it lower, they close it strong. They try to push it lower, they close it strong. It stays tight. And then ultimately leads to the breakout, tightness, and resulting tread setup of new spots to get in. So no, I think that's awesome, and hopefully you guys enjoyed that and found that helpful. So let's go ahead to the next slide. I can request control again, or Ryan, we don't have too many more slides left, but let's keep it like this. So this is a base breakout. Again, we're not going into the full details of when should you buy all the time. Again, just keeping it high level. This is where we set the pivot. This starts a base, you can draw that pivot in around here or even here. We're below the moving averages. They start to flatten. We're still within this base, this overall range. We rally up to that level. It's not ready yet, gets rejected right there. And then we pull back again. And then we finally have the breakout on this day right here. And we get nice volume here. And on the next slide, we've got a nice checklist for you of things to remember about breakouts. Here are 4 key things to remember when it comes to breakouts. Look for tight price action before and after. Look for higher lows. We've got a higher low compared to this low, Look for a clear pivot point, whether it's a short-term pivot point created by a few days or longer-term base pivots, and look for explosive volume like we saw right here. So that's key 4 things. Very simple. Keep it simple. repeatable, all of that, and you'll have success with breakouts. So moving on, Rye. So here's a pullback. We did a webinar last weekend where we went through the chart of CVNA. I think, it was right on this day that we looked at it. We were like, this pullback is pretty textbook. We've got a drift lower on a decline in volume. Textbook things for pullbacks. I'll have a checklist on the next slide for you. And then we have a range pivot that forms here.
It's 12 o'clock.
And we get a nice breakout and resulting short-term trend here. Who knows how it will react to this level or this level, but depending on your style, you could have entered here on the pullback where it was supported off the 10-week as well as the 50-day moving average. So that's a nice, clear example for a pullback. And again, we'll come back to this. I know I'm going through kind of fast at this point. We want to respect your time, but going to the next slide, we've got a checklist for you. Look for a drift back in versus just sharp decline in 1, 2, 3 days, right back to the moving average. Look for low volume on the pullback. Look for that range breakout or resumed upward move that we got as we broke through the tops of these bars right here. And then look up for a subtle pickup in volume. Not necessary, but always good. And we do get a little bit of that right here where it's higher volume than during the pullback. It's really for the base pivots that you want to see explosive volume, but I'm never going to argue with a pickup in volume through kind of not the base pivot, but more of a consolidation pivot like we saw here. So Raya, when it comes to pullbacks, anything that you want to emphasize in today's webinar?
No, I don't. So if you take recent examples in Uber, CVNA, a lot of these that pulled back and the volume completely was sucked out, and you would expect more downside. We didn't get more downside. There was a whole bunch of just expectation. What is the expectation based on the prior day's price action? Well, I expected let's say this stock to continue lower. Hey, it didn't. Then it pulled back in, and then I expected this stock to continue lower. Again, it didn't do it, right? So if you define a topside pivot and some sort of anchor in terms of price action and say that, hey, I'm interested if this were to break above this 4250 mini consolidation that it's built, right? What is it doing underneath that? Are you expecting that follow through to happen to the downside and it's not? Those are subtle positives that kind of add up. As volume being lower is an added positive on top of that. CVNA, if you think it's too volatile for you and the average daily range is 10%, it's not for you. That's perfectly fine. You can pull up Uber. It did the exact same thing. It pulled off, reported earnings, pulled back in, and then volume went away as it consolidated right around 45. There was a clear topside pivot that formed. People were expecting it to continuously break as the S&P 500 moved below the 50-day, as the Qs moved below the 50-day, but it wouldn't break that range. Our expectation was it would continuously break down because the market's pulling back, right? And then when that doesn't happen, the concept of expectation breaker, we can speak to that probably all day today or all evening. But there were multiple expectation breakers. And then when it broke that pivot to the upside, volume actually came in. The tightness that we saw was on low relative volume. That's trade identification. Having Uber on your watch list, saying the drift back in is on low volume. And if it goes above this particular pivot in the market and the volume tends to increase, which is not a requirement for consolidation pivot, it is for base pivots, then I will get into this trade and my risk is very defined. And when your risk is defined, you've seen this before, you can position size higher. That's how you make progress and move from stage 1 to stage 2, right? And then how do you keep it is moving from stage 2 to stage 3 as a trader. So we'll break each of these down. We're going deep into kind of price action only. And we could spend maybe the next couple of days just going bar by bar, showing you exactly how to kind of do it. But at the end of the day, if you want to, just go through your watch list today, identify areas that you think are tight on low price action, and look at, you expect what happened that particular day. What did you expect to happen the next day? If it's an expectation breaker, that's kind of a positive to the upside, right? If it is in line with your expectations, you continue to wait and define your topside pivots. So that's that's, we're trying to go deep into price action so that you can identify potential stocks to trade, and then we'll get into the bells and whistles of how you actually place a trade going forward.
Yeah, and the buzzes and whistles. And looking at this chart, what's your expectation now? How I interpret this is we've rallied for 6 days in a row. Looking back in history, we kind of get runs of 3, 5 days in a row. We're maybe a little bit short term extended. We're also running into this pivot where potential actors in the market might look at that and say, hey, that's a potential resistance level. Let me lock in some shares that I sold here. Personally, my kind of expectation and what would be constructive action would be for it to form another sideways to downwards trend here under that pivot, and then look for a continuation pivot there. I don't know if that's going to happen. This could take off tomorrow, and the market doesn't care what I expect. It's going to do what it wants. But based on looking at history, how constructive price and volume action happens over time, that would be constructive price action, because that would tell me that sellers again are getting absorbed in this range, and then we're reconfirming to the upside, ideally on a pickup in volume. So that's kind of how I interpret this. And as you look at more charts and trade more, you'll get a sense for what to expect, and your expectations will often get destroyed, but you'll learn from them. Go ahead, Ryan.
And the same is the same thing applies to the downside. It's no different. Just the trend of the market changes. You're, instead of being above the moving averages, you're below the moving averages, right? Your expectation is that this will your expectations change, and you say, this is going to maybe bounce off of here. It continues lower, right? So it's kind of the mirror image. If you can master it to the upside, it's the same mindset, the same kind of principles to the downside, in which I think, maybe in the future webinars, we can maybe cover an example of the downside as well, just to show people that again, we're talking about, what are we here today? We're here today for framework 1, which is building a foundation. And this foundation works regardless of time frame, regardless of system, regardless of how you trade in the markets. You can apply some of these concepts and build upon them going forward.
Yeah, and again, CVNA is a volatile name. Earnings impact price action. We're covering the basics, the foundation here. There's a lot of other things to take into account, average true range, all that stuff. We're focusing on this, the core principles here.